COGS is how you get from gross receipts to gross profit. On the EA exam, they'll test the simple formula and then hide what belongs in it. Start with beginning inventory, add purchases and production costs, subtract ending inventory. The key idea is matching. Inventory costs sit on the balance sheet until the goods are sold, then they flow through COGS. So what goes into COGS? Think direct costs of the goods sold, plus certain production support costs, materials including freight in, direct labor for making the product, and factory overhead tied to production. What does not belong? Selling and marketing costs like advertising. A classic trap is trying to shove period expenses into inventory just to delay or accelerate deductions. UNICAP is the rule set that forces businesses to capitalize more costs into inventory, both direct and certain indirect costs, when producing goods or buying merchandise for resale. It's not just factories. It can hit intangible production too, like film production costs. Exam tip. If you see a big producer or reseller, your default assumption is UNICAP applies, unless an exception kicks in. The biggest exception is the Small Business Gross Receipts test. For 2024, if average annual gross receipts for the prior 3 tax years do not exceed $30 million, the business generally is not required to apply UNICAP. On the EA exam, they love the phrase average of the prior 3 years. If the number is under the threshold, you can usually stop worrying about UNICAP capitalization rules. Inventory inclusion is about ownership and what's actually part of items held for sale. If title has passed to the taxpayer, it's inventory, even if it's in transit and not physically received yet. Goods you own but have out on consignment are still your inventory. But goods consigned to you are not your inventory because you don't own them. And land, buildings, and equipment are never inventory. Shrinkage is lost, stolen, or damaged inventory. Mechanically, shrinkage reduces ending inventory, which increases COGS. The exam twist is double counting. If you take a separate casualty or theft loss deduction, you must remove those items from COGS by reducing beginning inventory or purchases. You get 1 deduction, not 2. And if there's a reasonable prospect of insurance recovery, you don't claim the loss to that extent. Which of the following is not an acceptable inventory method for federal tax purposes? The choices include allocation method, LIFO, specific identification, and FIFO. Think about which ones are standard inventory flow assumptions the IRS recognizes, and which one sounds like a made-up catch-all. Think about it. The correct answer is allocation method. FIFO, LIFO, and specific identification are all recognized inventory methods. Allocation method is tempting because businesses allocate costs all the time under UNICAP, but that's not an inventory valuation method by itself. On the EA exam, if it's not FIFO, LIFO, or specific ID, be suspicious. Cedar Valley Foods is a fiscal year C corporation using the accrual method. What is required for the company to deduct an expense? The options mention paying before year-end, paying first, receiving an invoice, or meeting the all events test and economic performance. Focus on what accrual accounting requires for deductions. Think about it. The correct answer is meeting the all events test and having economic performance. Accrual taxpayers generally deduct when liability is fixed and determinable, and economic performance has occurred. A tempting wrong answer is needing an invoice because it feels like proof, but an invoice isn't the legal standard. Payment also isn't required just because you're on accrual.